Imagine you find $500 tucked inside an old jacket you had forgotten about. Now imagine you lose $500 from your wallet the very next day. The math works out exactly the same, but the emotional experience of those two events is not even remotely equal. The second scenario feels substantially worse, and that gap between how the two feel is not a quirk of your personality. It is a predictable, measurable feature of the human brain, documented across thousands of experiments, and one that costs investors real money every single day. Psychologists call this loss aversion. The core finding is this: the pain of losing a given amount of money is approximately twice as powerful as the pleasure of gaining that same amount. The gap is not marginal. Research consistently puts it at roughly double. That asymmetry shapes decisions that most people would describe as rational. Holding a losing stock too long, refusing to sell a home below the original purchase price, taking on more risk to avoid locking in a loss. Each of these behaviors feels logical from the inside because the brain is trying to avoid something that genuinely hurts. But the outcomes of these decisions often make the situation worse, not better. There is also a fourth pattern that almost no one recognizes until they see it laid out clearly. We will get there before this video ends. First, let us understand where this comes from and why it runs so deep. Loss aversion is not a modern phenomenon. It is a survival mechanism. For most of the human evolutionary history, losing resources meant starvation, exposure, or vulnerability to attack. The brain that responded faster and more intensely to potential losses was the brain that survived long enough to reproduce. The brain that treated a missed meal and a found meal as equivalent sensations died before passing on its genes. You are not irrational. You are running ancient software on a modern problem. The formal study of loss aversion began in the 1970s. Daniel Kahneman and Amos Tversky, two psychologists at Hebrew University in Jerusalem, were studying how people actually make decisions under uncertainty, as opposed to how economic theory assumed they did. Their experiments were deliberately simple. In one classic version, participants were offered a choice. They could accept a guaranteed gain of $50. Alternatively, they could flip a coin for a chance to win $100. Most chose the guaranteed amount. That part of the result was mostly expected. Then the researchers reversed the scenario. Now participants chose between a guaranteed loss of $50 and a coin flip. The coin flip either cost them nothing or cost them $100. Suddenly the pattern flipped completely. People who had just chosen certainty were now choosing risk, because the certainty on offer was a certain loss. The two problems were mathematically identical in terms of expected value, but the behavior changed entirely depending on whether outcomes were framed as gains or losses. Kahneman and Tversky formalized this into what they called prospect theory. Published in 1979, their central conclusion: the psychological pain of a loss is roughly twice as intense as the pleasure of an equivalent gain. They named the ratio the loss aversion coefficient, and research has consistently measured it at around 2 across dozens of populations and settings. In practical terms, this means the following: if you lose $500, your emotional account needs roughly double that amount in gains before it returns to neutral. The two figures are not symmetrical in the way accounting would suggest. Daniel Kahneman received the Nobel Prize in Economics in 2002, in large part for this body of work. Amos Tversky had passed away 6 years earlier. The field they established, behavioral economics, now informs how governments design retirement systems, how financial products are marketed, and how regulators think about investor protection. The principle has been confirmed across contexts that extend well beyond laboratory experiments. 3 domains show loss aversion at work in financial behavior, with enough real-world evidence to establish consistent patterns. The stock market. In the early 1980s, researchers Hirsch, Schifrin, and Meyer-Stetman analyzed thousands of individual brokerage accounts. The pattern they found was consistent and striking. Investors sold their winning stocks at a significantly faster rate than their losing ones. They held losing positions almost 50% longer than winning positions. The researchers called this the Disposition Effect, The logic behind the behavior makes sense from the inside, even as it destroys returns. Selling a losing stock makes the loss real. It moves the number from the hypothetical world of unrealized losses into the permanent record of realized losses. As long as you hold the position, there is always the story that the stock will recover. The story gives the brain somewhere to put the discomfort, but the market does not share that story. The stock does not know what you paid for it. Its future price is determined by future information, not by your cost basis. Holding a position because selling would feel like admitting failure is a financial decision made for emotional reasons. The research is clear on what this costs over time. Investors who trade least tend to outperform investors who trade most, in large part because frequent trading is often driven by attempts to manage the emotional weight of losses. There is a moment that many investors recognize immediately when they hear this described: the laptop you do not want to open. The portfolio page you have stopped checking because looking makes the number more real. I have been in that position, watching a stock fall day after day, reaching a point where even turning on the computer felt like a confrontation. What struck me was that the resistance to selling did not feel like a decision. It felt like something closer to a physical refusal. My instincts would not allow the loss to become official. What I eventually understood is that the holding was not protecting anything. It was only delaying the reckoning while the position continued to deteriorate. That experience convinced me that learning to manage these psychological responses is not a peripheral skill. It sits at the center of any sustainable approach to investing. Real estate economists David Genesove and Christopher Mayer studied home sales in Boston during a real estate downturn. Their findings were published in 2001. Sellers who faced nominal losses on their properties said asking prices significantly higher than comparable sellers who stood to profit. Homes at risk of a realized loss stayed on the market longer and, when sold, commanded a premium relative to market conditions. The sellers were not being irrational by their own logic. They were trying to avoid accepting a number below what they had originally paid. The purchase price had become an anchor, a reference point that the brain used to evaluate every offer. Any number below that anchor felt like a loss, even when it reflected accurate market conditions. The cost of this behavior was concrete: longer time on the market, missed opportunities to reallocate capital, and often a final sale price that was no higher than an earlier offer would have been had the seller accepted it. The teacher's study. The most counterintuitive evidence comes from outside financial markets entirely. Economists at the National Bureau of Economic Research ran a large field experiment with school teachers in Chicago. One group was offered a bonus at the end of the year if their students met performance targets. A separate group was given that same bonus at the start of the year and told they would have to return it if their students did not reach the targets. The financial incentive was identical. The only difference was framing. One group was chasing a gain. The other group was trying to avoid losing something they already held. The second group outperformed the first by a meaningful margin on standardized measures of student performance. The fear of losing something already possessed turned out to be a stronger motivator than the prospect of gaining something not yet held. This is loss aversion operating not in markets but in workplace behavior, with measurable consequences on real outcomes. The goal is not to eliminate loss aversion. That is not possible. The goal is to build a decision-making framework that keeps this bias from making choices in moments when the stakes are high. Pre-commitment. The most effective technique is deciding your exit conditions before you enter a position. Before you buy a stock, write down the specific circumstance under which you would sell. Set a stop-loss order or a price alert in advance. The decision is made before the emotional pull of a declining position exists. When that condition is met, you execute the rule, not the feeling. This matters because loss aversion is strongest when you are in the middle of an experience. The pre-commitment removes the decision from that moment and places it in a period when your thinking is cleaner. Separate the decision from the outcome. A common mistake is evaluating the quality of a financial decision based on whether it made money. A good process can produce a losing outcome. A poor process can produce a winning outcome. If you judge every loss as evidence of a bad decision, you will punish sound thinking and eventually stop applying it. Better questions to ask. Was the analysis based on available information at the time? Was the position sized correctly for the uncertainty involved? Was the original thesis violated by what actually happened, or was it simply a poor outcome from a reasonable bet? Separating process from outcome makes it possible to learn from losses without letting them dominate emotional responses in the next decision. Portfolio-level thinking loss aversion intensifies when attention is focused on individual positions. A diversified portfolio will always contain holdings that are declining. That is the point of diversification. The relevant question is not whether any single position is losing, but whether the portfolio as a whole is performing according to its design. Shifting from position-level monitoring to portfolio-level monitoring reduces the number of visible losses at any given moment. Fewer visible losses means fewer triggers for the aversion response. Reduced observation frequency research consistently shows that the more often you check a portfolio, the more losses you will observe, because markets fluctuate continuously. Each observation of a declining value activates the loss aversion response. The cumulative effect is a higher emotional load and a greater probability of a reactive emotional decision. Checking a portfolio monthly rather than daily dramatically reduces the number of loss observations across a year. Over time, this alone meaningfully reduces the frequency of decisions made under the influence of the aversion response. Reframe losses as data. The most durable shift is treating a losing position as information rather than as a verdict. A position that is down tells you something about the position, the thesis, or the market conditions. It does not tell you something about your intelligence or your value as an investor. The brain wants to make losing mean something beyond the financial numbers. That meaning-making is where the worst decisions come from. The investor who holds a bad position for 2 years because selling would mean admitting a mistake is paying a very high price for an emotional protection that does not actually protect anything. Losses are data. They are telling you something. The job is to hear what they are saying, not to argue with them. If you have ever held a position longer than you knew you should, you now understand the mechanism behind the choice. It was not weakness or lack of discipline. It was a feature of human psychology that runs deeper than most financial educations ever acknowledges. Subscribe if you want to keep understanding the patterns that shape financial behavior at the level most people never reach. Sources are listed in the description below.